All right. Hi, everyone. We are live. Welcome to Market Matters. My name is Katie Kuntz, and I'm a social media editor here at CNBC. I'm joined by our senior markets correspondent, Bob Pisani, and today we're going to be answering all of your questions about the latest stock market moves. Nice to see you, Bob.
Hello, Katie. How's your summer going?
It's going well. I know you've had a busy summer.
I went to Italy. I'm going to go to California to wine country in a couple of weeks. Go to Josh Brown's Future Proof conference, which I'm looking forward to, and maybe a trip to the Caribbean or two in the fall somewhere. Yeah, I'd like to travel. It's busy out there, I will tell you, and they're not lowering hotel prices or restaurant prices. I can tell you that as well.
Yeah, exactly. I've definitely experienced that myself. So great. Let's just jump into all of our questions for this week. First up, Bob, what has been driving stocks lower this week?
Well, there's a couple of problems. Number one, you have China. China is having some problems. The recovery has not gone the way they wanted. Demand is much weaker. Youth unemployment is so high, they're actually going to stop reporting it. That's not good. It was over 20%. So whenever the Chinese government has a problem, they seem to just want to stop reporting the numbers, which of course is ridiculous. Then they had some real estate issues. You know, they've been pumping up real estate for years. And that seems to be the answer to everything. People aren't sure about what they should invest their excess savings in. And the answer has always been real estate, even over the stock market. There's a lot of money in real estate, probably way too much. And so they have these periodic slowdowns, crashes, where they just have to keep pumping more money into it. So that's one issue. And that's been affecting a lot of stocks in Europe and the Far East. Then we have the U.S. economy. It's not quite Goldilocks because the data is a little stronger than people want. We want this perfect thing where the economy slows down just enough to make the Fed not want to raise rates and avoid a recession. And some of the recent data has been very strong. This is good news. U.S. economy is strong. Job growth is strong. Retail sales have been strong. But there is a concern that inflation may not come down as fast as people think, particularly wage inflation recently. So this is creating a little bit of concern here. Remember, the whole scenario, the soft landing, is interest rates come down slowly, inflation comes down, and then we sort of stop hiking rates. Recently, there's been concern that the Fed's not going to stop, that rates are going to stay higher for longer, and they may even raise rates more than people expected. We're basically thinking this is the end of the rate hiking cycle. So Powell is going to be speaking in Jackson Hole next week. This is the annual Kansas City conference. And up a couple weeks ago, everybody was expecting him to pivot away from, more rate hikes and things like that. But that may not be the case. Powell may be much more hawkish next week. He's speaking on Friday, and we'll see. But that's the concern of the market. So rates have been creeping up. That's the simple story. 10-year yields are, well over 4%. And that's putting a lot of pressure on interest rate sensitive groups, particularly technology stocks. Technology, communication services, your Apples, Microsofts, Metas have all had a tough time. Apple's down 12% this month. So that's the main concern. Higher rates, Fed higher for longer, maybe even Fed hiking more than people anticipated. Frankly, this has been a garden variety correction. We're only off 5% from the highs. There's hardly any panic. This is the summer. The volumes are light. Volatility is low. The VIX is below 20. That's the volatility index. I don't pay much attention to the VIX below 20. That's about the historic average for the VIX. It was 13 a little while ago. Now it's higher. It's been creeping up. It's 17, 18. But bottom line is, 13 is an anomaly. 13 is weird, weirdly low volatility. 18 is still below normal, but higher. So there's no panic out there. There's no heavy selling. There's no anything. It's just a little bit of concern about things are not quite as Goldilocks as people anticipated. I am not that worried about this right now. It could go a little further. We're trying to rally. The S&P just went positive briefly while I was sitting here. So there are attempts to rally, but I don't think there's tons of enthusiasm for buying stocks. That's the problem. It's not that people are selling. People aren't just enthusiastic about buying. And you can buy a one-year treasury for 5%. And a lot of people say, well, why should I worry about stocks if I can just own 1-year treasury at 5%? So bond market is big competition for the stock market right now. I think that's it in a nutshell. Higher rates, competition for stocks, and a little bit of China.
Well, we'll definitely be watching all of that, and especially Fed Chair Powell next week in Jackson Hole. So Bob, but you brought up the Treasury yields. Can we dive into that a little bit deeper? What's happening there? What does it mean for investors, those movements?
Well, there's two things. Number one, there's the perception of the economy. Again, I said this before about Goldilocks. If the economic data is a little stronger than people anticipate, that means the Fed may keep rates higher for longer and may actually hike rates more than people anticipated. Again, we're expecting the end of this rate hiking cycle, but it may not happen. And you can see rates creeping up a little bit on that. So that's one concern. Another concern is the supply-demand equation. We're about to sell enormous amounts of treasuries to finance the debt, a lot. So high supply, demand, think about this, you dramatically increase supply, usually prices go down. That means in the treasury market, that means yields go up. So there's not just an economic issue here, there's a supply issue on top of that. Then there are other macro issues around things like the yen carry trade. For decades, the yen was very, very cheap because the Japanese government kept interest rates low, in fact, negative. And so it was really cheap to borrow money in yen and go buy stuff, including treasury bonds. That is stopping because the yen has been appreciating in value recently. And so there's all sorts of issues that sort of come into play here. It is not just with the US economy. Again, it has to do a little bit with demand, supply and demand issues, a little bit with the yen carry trade not being as influential as it used to be. So it gets a little complicated, but the bottom line is what we saw a few years ago with 10-year yields of below 1%, it's ridiculous. That's an historic anomaly. What we're doing now is much more normal. It's much more normal for the 10-year yield to be in 4%, 5%, 6% range, if you look at the history of this, than it is to be in 1% or below. So what we've been through in the last few years prior to this was what was weird. This is not weird. Bonds should offer some competition for stocks. You should say, well, all right, why, if I can get 5%, why not? So I don't have a problem with the 10-year yield at 4%. I'm not particularly thrilled with 30-year mortgage rates going at 7%. But again, what's weird was what it was. 30-year mortgage rates at 3%, that's an historic anomaly. I grew up in the real estate business. My father was a home builder, my brother's a home builder, my wife's a real estate agent. In 1978, 30-year mortgage rates were approaching 20%. When I bought my house in 1986, 30-year mortgage rates were 11%. Now people are freaking out when they're 7%. But I'm going to tell you, just like the VIX, the volatility index, is weird at 13, it's weird at 3% on a 30-year mortgage. 6-7% is a much more normal range for it to be in. So I'm not happy about it. It's definitely increasing the cost of owning a home. And combine that with constricted supply in the housing market, the cost of homes are going up. That's a problem. I expect that to reverse. I expect home prices to be peaking out. People are going to start pushing back. They're going to bid prices. So think about this. I know I'm talking about real estate now, but this is related to treasury yields because the 30-year mortgage, there's a relationship generally between the 30-year mortgage and 10-year yields. It's not always exact, but there's a relationship. So what we need to see now is with mortgage rates at 7% and supply constricted prices going up, the average person looking to buy a home is going to look at a home and they're going to do one of a couple things. Number one, they're not going to do anything. They're not even going to leave their home. Number two, if they leave their home, they're going to either pay more of their budget for housing by taking that mortgage with a higher priced house, or they're going to bid down the price of the house. They're going to try to adjust the house down so the mortgage can get in line with them, what they can afford. So I think that's a very plausible path to the next year and what's going to happen in home prices myself. And that's just assuming we stay at 7% or so on the 30-year. So look, there are good things. It is good to be compensated. It is insane for anyone to want to give the government money for 10 years at 1% or below 1%. It is crazy to do that. Well, who would do that? Now you get a 10-year at 4%, you get a 1 year at 5%. It's over that, but that's much more compelling for savers, and I like that. So I don't have a problem with the way things are right now. It's much more historically normal, even though I know it's painful for some people.
So, Bob, up next, let's dive into the banking industry a little bit more. What impact will the threat of credit downgrades have on U.S. banks?
Well, remember, Fitch started this off. They're a credit rating agency. That's what these guys do. They get paid to rate things, everything's bonds, companies. And they warned a while ago that dozens of banks could have their credit ratings at risk. And Fitch said it wasn't the banks. Fitch said the reason they're unhappy is they don't like the way U.S. is conducting their policy, their fiscal policy. So Fitch downgraded the credit rating of the United States, not the banks, the credit rating of the United States, partly blaming a sort of erosion of governance, this constant war that we have to extend the debt ceiling, for example. They said this isn't good for the country. And the reason banks are a little bit of threat here is, according to Fitch, banks can't be rated higher than the environment in which they operate. If they think the environment in which they operate is deteriorating, that's a problem. On top of this, higher interest rates for longer would weigh on the bank's profit margins. So think about this. I made a joke about my mother months ago calling me from her bank, pulling money out of her bank account to put it in bank CDs, which is not a bad idea at all. She was getting 0.3% in her bank account. She was getting 4 and 5% on the 1 year bank CD. That's a no-brainer right there. So the problem is that the banks are going to have to pay my mother more to keep that money in that 0.3%. My mother doesn't want to do it, and she's right. Now, that's a yield top story. When your mother calls you and says, Robert, I'm standing in the bank and I'm going to get 4 or 5% on my 1 year, 1 year's bank CD. Why should I keep it in my bank account? And I said, Mom, you absolutely should not keep it in your bank account. However, you should know banks are going to have a problem with their profitability because you're pulling money out and they're paying you 0.3%. And now they're going to have to pay you in these bank CDs. They don't like that. It's going to hurt their profitability. And you know what she said to me? She said, Robert, I could care less about the profitability of the banks. They gave me nothing on my savings for years and years and years. And now I have a better alternative. And you know what? My mother's right. Why would my mother give a damn about, PNC's profitability? So I completely understand what she's doing. So remember, some of these credit downgrade threats are threats about the operating environment being poor. And some of this is just about higher interest rates for longer and how it impact the profitability of the banks.
So, Bob, let's talk about something that a lot of people are really curious about these days, which is AI, artificial intelligence. What is the importance of AI in the modern financial markets?
Well, it's not the financial markets you think about. It's in general, in life. So what makes companies profitable? How do you get a raise? And what makes companies profitable, how you get a raise, is you improve productivity. The key word is productivity. How much output per worker? If I can do a little bit more work or more output, whether I'm working longer hours or I figured out some more productive way to spend my 8 hours a day at work, for example, if I can find some magic that will improve my output, whether it's widgets or knowledge, or I write more stories, whatever, I could argue that I should get a raise. This is how you get a raise. Companies don't just give out raises willy-nilly. They have to show improved profitability, and that is normally tied to improving productivity. So the promise of AI is really nothing new. AI promises to improve productivity. How does that happen? Well, on the simple way to understand this is it cuts out a lot of needless repetitive actions. So, for example, this already happens. 20 years ago, we had this software as a service business emerge, where suddenly companies that had to hand do payrolls, for example, suddenly got software that automated it all. Well, what happened to all these people who used to write out the payrolls reports? Well, they found other jobs. That's what happened. Software came in that automated a lot of this, and now you don't even notice it anymore, that the whole world runs on software. So this is the promise of artificial intelligence. So you may have back office functions that could be easily automated. And you may say, well, what happens to those people there? Well, they'll get other jobs. When I was in college, this is 50 years ago, my job, one of my jobs was I was a telephone operator. So they'd call into the building and say, I want to talk to room 210. And I'd take out the wire and put the wire in the slot, and they'd connect to the room. Well, what happened? You know, there were hundreds of thousands of these people in the 20s, 30s, and 40s, mostly women, that were telephone operators. Well, by the time I was there in the early 70s, it was almost done because there was software that automated all this, even by the 1970s. And today, there aren't any telephone operators. Well, maybe there's a few. But you get my point. What happened to them? Did they lose their jobs? Well, yeah, they did something else. So the new jobs were always created. There was a study out a little while ago, 60% of the jobs in the United States, the descriptions of what people do, did not exist in the 1940s. 60% of the job descriptions didn't exist. There was no software engineer. There were no knowledge workers of any type anymore. The businesses, technology has created whole new opportunities in businesses to make things more efficient. So rather than say, oh my God, somebody's going to lose their job because of technology like AI, I got news for you. Somebody's always losing their job because of new technology. In the early 1800s, when the Industrial Revolution happened and the first machine-powered weaving looms made clothing, machine-powered from steam, from water, happened in the early 1800s, there were riots. The people who were weavers were furious. And some people lost their job over it. But a lot of new jobs were created in the cities around doing automation and factory work. And you could say, well, factory work is backbreaking, but a lot of people are moving on, and most people aren't doing backbreaking work in factories anymore. They're doing services. Most of the US economy is a service economy. We don't make as many things as we used to because service business is a more profitable business, makes more money, higher productivity too. So again, AI is just an extension of all of this. Now, some people might say it's a supercharged extension. Yeah, that may be true. But I look at this as a way to help advance mankind, make things better, more efficient. And believe me, we could use more things being more efficient. You'd be surprised how much waste and nonsense there is in the world. On a personal level, let me tell you what I'm looking forward to. I'm dying to have a personal digital assistant. You know, Bob AI, Bob 2.0. Who is this Bob 2.0? Well, it's just software. And it'll say, I can say to it, can you tell me, I want to go to the Jersey Shore this weekend. What's available? And within a sub-second interval, it'll pull it up. Now, I can do this now on a computer, but it might take me an hour to look through all of this. I don't want to spend an hour doing this. If I have my Bob 2.0, he'll know instantly. I want to go on take my wife to Paris for 5 days. What's available right now? What's the cheapest flight available right now? In a sub-second interval, he'll pull that up. Now, that Bob 2.0 will get to know me. Here's the creepy part, better than I know myself. And he'll eventually will even, depending on how much I allow it into my head, I can stop it, but depending on how much I allow it, he'll start making suggestions and commenting. Now, some people are going to love this. I personally do like it. Other people are going to be horrified by it. Other people are going to be very paranoid that it'll share this information with, Google, who will use it to sell me more crap because it'll my Bob 2.0 will know more than I do even when I go on and buy stuff online. That is definitely an issue. But would you like somebody to help you out for your harried day to, make sure that, all the stuff you need to do and get done every day? Think of all the stuff that you do every day that you are time wasters. There are more efficient ways to do things. And that's what AI promises to do. So think productivity. Think, how can we improve the way we do things? How can somebody get to your house to fix something quicker? How can it get fixed just using software? How do we improve the quality of people's lives? And worry less about job displacement, because that is happening all the time. It's always been happening. It's been happening for 200 years. They don't make buggy whips anymore. That's an old joke, right? But they don't make a lot of things. There ain't no telephone operators either anymore. There was when I was around in the early 70s, but they're all gone. And I found a new job. Here I am doing this. So be optimistic.
Yeah, I think that's a good way to look at it, Bob. And the historical context for all of these changes is definitely helpful. So next, you published a Trader Talk today, which I would encourage everyone after this to go and check out. But you're saying that most stocks do not outperform treasury bills, and there's really only a handful that account for most of the gains in the stock market. So
yeah,
you tell us about that and what that means?
I'm really very fond of this story. And if you want to see it, you can go to my Trader Talk page, tradertalk.cnbc.com. It's right on the top there. But I like looking at academic research on the stock market. Most of it's kind of boring, but this was amazing. This was a study that took place over 30 years. They looked at the global stock market, I mean, everything. 64,000 stocks in dozens and dozens of countries. About a quarter of them, about 17,000 stocks, were in the United States, and they broke it out. The amazing thing, there's two things that's absolutely amazing. Number one, it concluded most stocks don't outperform treasury bills. Those of you who don't know what a treasury bill is, short term, like 3 months, 6 months. They offer historically in the last 15 years very low yields. We're talking like 0.2%. Most stocks don't even outperform that. That sounds ridiculous, because we all know stocks are riskier than bonds, and stocks are supposed to outperform bonds because they're riskier. And that is true, providing you look at a certain groups of stocks, like indexed stocks that are in indexes, like the Dow Jones Industrial Average or the S&P 500. But most stocks don't. Most stocks lose money. And if you look at a couple other things, so I'm going to say these 17,000 stocks, most of them lost money. There's not 17,000 stocks that trade in the United States right now. There's less than 5,000. But they studied 17,000. How is that possible? What happened was they all went out of business. They went out of business or they got merged. Most stocks fail in the 30 years. They come in, they come out, they're there for 10 years, and they go away. You don't see it because we don't pay any attention to the losers. We just look at things like the S&P 500. That's 500 of the largest stocks. But think about what happens in the S&P 500. They just keep adding the winners to it, and the losers go away. So it's a biased index. It's biased in the sense that there's survivorship bias. That's why the S&P goes up about 10% a year on average, because it tends to have the winners that are in it. And so what the study did was it looked at all of these thousands of stocks and concluded most don't outperform treasury bills. In fact, less than half of U.S. stocks outperform treasury bills. The second thing it noted was a small handful of stocks account for the bulk of the gains in the stock market that we see. So I'll give you an example. 5 companies accounted for 10% of all the global stock market wealth in the last 30 years. By stock market wealth, they measure how much is the market capitalization of these companies going up over the last 30 years. 5 companies, Apple, Microsoft, Amazon, Alphabet, and Tencent, which is a Chinese company, those 5 companies accounted for 10% of all the stock market wealth of the last 30 years. Now, this is 64,000 companies. 5 of them accounted for 10%. And about, in the United States, 17,000 companies they looked at, about 44 of them, as I recall, that's about 0.25% of the sample, a quarter of 1% of the sample. 44 companies accounted for almost half of the gains. That's a tiny, tiny group of people, of companies, 44 out of 17,000. So what does this mean? There's a few things that it means. Number one, the conclusion of the study is very few investors possess stock picking skills that can outperform the broad markets. Almost nobody. Number one. Number two, the surest way to get decent returns is being broadly diversified. Don't try to pick a few stocks and hold on to and think you're going to win. It doesn't win. And the best way for broad diversification is to use index funds, like owning the S&P 500. Most people know this already, but this study really pounded this home. The third thing that's really amazing to me is that how much creative destruction there is in the stock market. They studied 17,000 stocks in the United States over 30 years, and most of them have come and gone. You don't notice it, but they go away. And that it's illustrative of how amazing the US economy is. Companies start up, they go away. Jobs get created, they go away. Pizza places get created and they go away. Think about it. You don't normally look at it this way, but that's what happens. And so it's a very dynamic economy. The US economy is astonishingly dynamic because it's easy to start a company and also easy to fold it. Good bankruptcy clause. And this is part of the reason that most of the big stock market gainers of the last 30 years are American companies. It has to do with the dynamicness of the US economy. And this is one of the positive conclusions. It's very obvious when you look at this study. So if you're really interested in, figuring things out, the study is 65 pages. It's a lot, but there's a link on my Trader Talk page if you want to see it, tradertalk.cnbc.com.
Yeah, definitely check that out. Bob, that kind of brings us to our last question, which is, how can I start investing as a beginner? What are your thoughts?
Well, we've talked about this a lot, and I have a book out. Not to plug my book, but Shut Up and Keep Talking: Lessons on Life and Investing from the Floor of the New York Stock Exchange. It's been out for a few months. There are several chapters on my own personal investing story. Rather than sit around giving you advice or what advice I have learned by hanging out with professional investors, I tell you a little bit about my investing starting in the early 1990s when I got my 401k with CNBC, which was owned by General Electric. And I described some of the stupid things I did 30 years ago and some of the smart things I did, including meeting Jack Bogle, the head of Vanguard, in the mid to late 1990s, and how that changed my life. I've been an indexing guy, a Jack Bogle guy, since the late 1990s. This study I talked about just a few minutes ago only reinforces my opinion, the value of broad diversification in the stock market. So if you want to start out, listen to the people who really know, whose opinions I respect the most. And they will tell you, if you are young, own an index fund. If you only had one thing to buy, it seems very obvious to me, an S&P 500 index fund is what to own. Some people ask me about owning bonds in this environment. Sure, you can consider that, but don't try to beat the market. I know some people think they can. So Jack Bogle always used to say, take 90% of your money and put it in index funds, and then take another 10% that's left over and go ahead and try to be a genius and outperform. Go ahead, pick the next Apple. I bet you can't. I bet it won't outperform. Not over the long term. Don't tell me you just made money in the last month. I'm talking about 10 years. That's what the time horizon you should look at. So I always would start with broad diversification. Nobody would disagree with you on that. And broad diversification, the best way to get that is to own an index fund like the S&P 500. You can own the Russell 2000 too. Look at IWM. You can own, if you want to own tech-oriented, you can own the NASDAQ 100. And that's available out there too. QQQ. You can buy those very cheap if you want. But there again, broad diversification is always the key, and understanding your risk tolerance. How comfortable would you be if the market dropped 20%? Oh, by the way, that happened last year. The S&P dropped 20%. Were you comfortable then? Did you freak out? Did you sell? Probably a dumb idea, because look how well it's doing this year. See, you can't do market timing. It doesn't work. So learn what your risk tolerance is, stay invested for the long term, and be broadly diversified.
Yeah, I think that's super helpful for people, Bob. So thank you for answering all of our questions. As always, good luck with all of your travels in the next few weeks, and we'll talk to you again soon.
And I'll be in California at Josh Brown's conference in a couple of weeks, and looking forward to that. It's going to be a great conference.
Yeah, looking forward to hearing all about it. So thank you everyone for sending in your questions, and we'll talk again soon.
Take care, Katie. Take care, everybody.